All right, what's going on, guys? Welcome to today's first class. My name is Jerry B. I want to first extend a warm gratitude to you all for giving me a warm welcome. I've been trading for about 6 years, and I specialize in swing trading and making data-driven decisions. I like dark pools, order flow, and using those key levels to kind of justify my risk to reward for the upside or the downside. So for today's class, it's going to be very simple. We're going to focus on three key objectives, and I'm going to leave some time towards the end of the session for any questions. So the first thing we're going to focus on is consolidation. So a little bit of market structure, what Rico, Jaden, Wall Street, and of course Sierra, what they've kind of already taught you guys. I'll be touching on consolidation, retracements, expansions, as well as rejections. Okay, and these are just some key terms to kind of help us drive our price action decisions. Next up, we'll be talking about risk management, of course. And then I'll go over the long and short tool so you guys can know how to actually model your risk to reward within your respective charts. And we'll conclude with a brief Q&A session. All right, so without further ado, let's go ahead and dive into that. So does anybody know what consolidation is in a nutshell? Let me know in the chat. Great answer. Sideways. Buyers and sellers can't agree on price. Price stays in the same place. Exactly. So in short, we're just going to say indecision. All right. And next to that, I'm going to write doji. And the doji is a candlestick, which looks like a plus sign, which tells us where there was essentially a tug of war between both the buyers and the sellers at some key level. Let's say 100. Right. So from, let's say, price was at 105. Sellers were selling price into 100. Price was probably at, let's say, 95. Buyers were pushing price into 100. And then in the chart, we might see a doji candlestick. Okay, it's essentially telling us an area where we have sideways price action, right? Now, the next keyword we have is retracements. Does anybody know what a retracement is? Retracement, expansion, breakout. Any ideas? Exactly. Retracement is essentially a pullback, or another common word that you might hear is a retest of structure, which gives you an additional confirmation for either the upside or downside. Mr. Wall Street uses this term a lot in his recaps. So this is going to be very important with allowing us to be able to model our risk for both the upside and downside. So a pullback into some area, okay? Now let's say this is our sideways price action, right? And let's say we get a breakout. Price is clearly showing us strong momentum to the upside. You could take this trade at the immediate breakout, but it would make more sense to wait for a retracement back into that sideways price action or demand zone, support and resistance, whatever you trade. we're looking for price to return back to that major key level. Or if you're a long-term investor, we're looking for price to dollar cost average down if we're trading at a key hold number, and then average in to take that trade back to the upside. Okay, so this pullback is our retracement. Okay, now the trade that we love to take are 9 times out of 10, we can identify them as expansive moves to the upside. So an expansion to the upside. So let's put this all together using 2 simple candlesticks. So the first candlestick that I like to identify on the chart is the doji. The doji tells us an area or zone or range, support and resistance, where there's equilibrium, indecision. Buyers and sellers are at a standstill. They're trying to figure out if they want to drive price to the upside or the downside. Now, when price does break out of that key level, we can use our large candles as a key indicator of upside or downside momentum. So our expansive move, those long green candles or the long red candles that we see whenever price is breaking out to the upside or breaking down to the downside, those are Moribozu candles. Moribozu is Japanese for shaved head. So they have little to no upper wick, indicating strong price action to the upside or downside, right? Now, whenever price breaks out aggressively and we try to chase those trades, 9 times out of 10, price comes back down to reverse against us and bites us in the butt, forcing us to either A, get out of the trade, or B, average down to take the trade higher. So what we can do is kind of think ahead and say, okay, I see that price is breaking out on QQQ. It's breaking to the downside on SPY or whatever ticker that we're trading. It would make more sense to wait for price to come back into that support level or key resistance level before taking the trade, right? Would you all agree? All right. So for the most part, most of us agree. Okay. So when price breaks out to the upside, we're looking for price to return back into our key level for a retest of structure for a lower risk trade. And then we can take it to the upside. Same situation here for breaks to the downside. We get a clean break indicating strong momentum to the downside, price retest structure, and then we can take the trade to the upside, targeting the previous high as a price target. Same thing for the upside, right? And now we can take this information and utilize our long and short tool to model, quote unquote, our risk for the upside as well as the downside. So what does that look like in the chart? So first, let's go ahead and identify some consolidation areas as well as retracement zones in our trading view and just kind of see what that looks like in real time. Which stock would you guys like to look at for next week? QQQ. I don't trade futures. Carvana. I like AMD. Let's look at AMD and QQQ. Okay, let's take a look at QQQ, starting with a fresh chart. For the indicator, I'm going to use the 9 EMA. Actually, let's just take off all indicators for now. All right, so first things first, one thing that I like to do whenever charting is look at the higher time frame and then zoom in to the lower time frame to model a higher risk to reward scenario. So starting with the weekly time frame, I'm looking for the doji, as I mentioned before. So as I can see here, there's a doji here indicating an area where buyers and sellers are at equilibrium. So what I'm going to do is just circle this entire range in gray. So this is the point of interest or range that I'm looking at for the week. Price could come back into this zone, or this entire zone could turn into supply, quote unquote. And we could target these lows down here into this other area where there was indecision, nothing but buyers and sellers. Diving into the 1 hour time frame, I am looking for the same thing, an area where there was equilibrium, buyers and sellers, a doji. All right, I see that there's a doji here. So I'm going to mark this off as my reference point for supply. Now within this aggressive push to the downside, I'm also looking for another doji for my reference point for demand, which I can see is here. Right, now in this chat, we like to trade off of vibes. All right, so what I'm going to do is refine the zone based on where price gave us an aggressive impulse move to the upside. So as we can see here, there was nothing but buyers on this entire candlestick here. We also had strong price action for the upside as well today within this range. So I'm going to move my zone to the low of this doji that I just marked off. And I'm also going to move my zone for my supply zone to the low of this doji as well. So that I can kind of stay on track with what these zones are, I like to label my charts because I like to, swing trade, and it just helps me keep track of my higher time frame analysis intraday or intra-week as I model risk throughout the week for the upside as well as the downside. So for supply, I'm going to call this 1 hour supply. And this is going to be my 1 hour demand. Now this gray zone was our area of equilibrium where buyers and sellers were virtually indecisive, consolidation period or whatnot. We found this on the weekly. So this entire gray zone is weekly supply. This gray zone down here is our weekly demand. All right, so based on these two key levels, I can already see that there's a bearish bias for price going to the downside. Why? Because we have strong momentum breaking through this area of consolidation. Strong bearish momentum going to the downside. If you trade ICT or SMT, all these abbreviations, this would be considered a break to the downside, or bulls, quote unquote. So I'm looking for a continuation to target this low so that we can retest this weekly demand before looking for longs back to the upside. Now, if price were to be bullish, we could look for price to retest this lower time frame demand at our 1 hour demand zone and take longs back up to the upside. So how do we model that and prepare for it in real time? One thing that I would do here is mark off the long scenario. So in a bullish scenario, if price were to hold my 1 hour demand zone, I'd look for longs up to take out this high. However, since we already have a strong bearish bias, as indicated by these strong bearish candles here, these strong bearish Moribozus that we explained in our model here, right? We have that breakout away from our sideways price action. There's a higher risk to reward to wait for price to retest our resistance to take price to the downside, targeting this previous low here. So in the chart, what does that look like? We have an area of indecision here. This entire range, this entire gray zone here, right? Price gave us that break to the upside, confirming that big banks, institutions want to move price to the downside. Now we have our retest into that zone of sideways price action. So the next PT for the downside, we will be targeting this low here for a potential continuation into our weekly demand. So instead of looking for longs, there's a higher risk to reward for the downside, utilizing this supply zone up here. So in an ideal scenario, next week, I want to look for price to give us a push to the upside, take out these highs, come back to the area where buyers and sellers were at equilibrium, which is indicated by this doji here, before looking for shorts to the downside. Now, if I were to scalp this on the lower time frame, by all means, we could easily take longs up into this zone or this area of equilibrium, right, as indicated by this doji here. We could easily scalp longs here and then look for shorts immediately once price comes into that 444 psychological key level. So 444 would be my entry for puts. 444.5 would be my stop loss. Where is my keyboard? There we go. 444.5 would be the stop loss. And then the price target would be to take out this low to continue that momentum to the downside into our higher time frame, quote unquote, demand zone on the weekly. And by utilizing these tools, it's allowing us to visually understand where we are within the charts relative to the numbers. So if price were to break and hold 444.4, then we would know that our bias is invalidated and that we can take longs to the upside to target these highs up here, which was Thursday's high, right? Because structure would have changed and flipped to bullish. Now, if we continue to see weakness as we approach our weekly supply or retest our weekly supply, which looks to already kind of giving us a confirmation that it wants to continue to the downside, then we can immediately look to target Thursday's low and then look for continuation down into that weekly demand zone and possibly fill in this large imbalance or gap in structure. So puts 444 reject, stop loss 444.5 if you want to keep it tight, 445.5 if you want to have a little bit of wiggle room, and price targets. We have 435, key psychological level. Now, why is this tool important? So these tools can be found in your trading view by going to the drawing area. You can scroll all the way down to forecasting and measurements, and you'll see here I have a star by long position and short position. For years, this has given me confidence to be able to stay in my higher time frame trades, to scalp multiple times throughout the week, as well as take trades, to the upside as well as the downside by targeting various inefficiencies within price. So I know I talked about a lot, so I'm going to give you guys a 3 to 4 step process that you could possibly implement into your respective trading strategies. So first things first, we want to see a reason for price to go to the upside or downside. we want to ask ourselves, why bull or why bear? And the way that I personally confirm bullish or bearish price action is by looking for a strong break to the downside or upside out of a period of consolidation. So we want to see a long red candle, or a Morobozu if you want to be technical, to the downside or upside to confirm the momentum, right? Or breaking structure, if you trade ICT, breaker candle, whatever, you're just looking for a big push, big green candles to the upside or big red candles to the downside to indicate momentum. All right, once we get that confirmation, I'm looking for price to come back into our consolidation zone for a retest of structure. Once I get bearish confirmation again on the lower time frame, then I'll look to take the trade and target the previous candle's low before the aggressive push to the downside. That was a mouthful, so I'm going to try to break that down for you again. So when price breaks out of our consolidation period, let's say we're trading at $100, right? And it breaks to the downside and touches, I don't know, $97. I'm looking for price to come back in to fill in the inefficiencies between $97 and $100 and reject $99 so that I can target $97, 96, 95, et cetera, et cetera, et cetera, right? While having 100 or 100.5 as my stop loss. Now for a bullish scenario, I look for price to break to the upside, wick through, let's say, $103, come back into that consolidation zone to fill in some inefficiencies between $103 to $100, look for a impulse move at 101, and then I can target 103, 104, 105, and I'm using the risk to reward tool to help me gauge and mitigate my risk, and of course manage my bias for both the upside and the downside. Okay. So first things first, we want to understand our overall bullish or bearish bias on the weekly time frame. Go down to the 1 hour time frame and look at how price is reacting to those higher time frame zones. So identify HTF is an abbreviation for higher time frame supply. Weekly S&D. And then we can identify our lower time frame supply. I personally like the 1 hour time frame as I'm a busy professional. It just helps me stay in my trades longer for swings and whatnot. But if you prefer lower time frames like the 15, sometimes even the 5 or even the 30 seconds, by all means, you could do that as well, as the market is relative. So lower time frame, 1 hour, 15-minute, etc. Supply and demand. And then the last and final step, I model risk using the long and short position tools. All right, so now I'm going to speed up this process a little bit and do the exact same thing for AMD, and then we'll open it up for any questions. I don't like this little keyboard. This is giving me anxiety. Why is it so little? I need the thick one at the bottom. Okay. AMD. Let's take a look at the weekly time frame and identify the dojis, an area where there's indecision. Okay, when I look to the left, I can see that price recently made an aggressive push to the upside to create some all-time highs. And with every green candle, it always leaves behind some inefficiency. Whenever we see a strong Morobozu candle that has little to no upper or lower wick, there's inefficiencies that are left behind that price could come back into before going back up to make another higher high. So based on this alone, my bias is that AMD could come back to the downside, possibly to like 155, maybe 160, so that long-term investors can dollar cost average down before going back higher to the 200s, 225, etc. But for now, we're just going to keep it simple and follow the rules and mark off the doji here as our higher time frame supply zone. And then let's identify the higher time frame demand, which is this doji down here. Right? And we could also utilize confluence within this demand zone and look for 2 or more touches for support. We have 1 touch here, 1 touch here. So this is a strong area or strong buy zone based on, basic technical fundamentals alone. So 2 touches of support gives you, or 2 touches of a key level gives you support, 2 touches of a key level of resistance gives you resistance or supply. And I'm utilizing price action candlesticks to kind of give us an extra confluence or extra edge within this assumption. All right, so weekly demand as indicated by this doji, weekly supply as indicated by this doji, and resistance, looking for 2 touches of a key level for resistance. Since price is trading at 170.5, I'm just going to utilize this key level as my resistance. So 1 touch here, 2 touches here, just trading off of vibes. So let's say 172. All right, we got weekly supply. And we have weekly demand. Let's drop down to the 1 hour time frame and look at how price is reacting to our weekly supply zone. Price appears to be heading to the downside. We also have a break below our 21 moving average. Actually, this is the 9 moving average. We have a break below our 9 moving average. Price is also holding below the 50. So we have a bearish bias there. We have our candles, the big break to the downside, bearish Morobozus indicating strong bearish momentum, right? Which was our step 2. in our sequence. So we have that big break to the downside. We're looking for price to come back up into that Morobozu candle to fill in some inefficiency and then take out that previous low. So in real time, price came all the way down to 166.2. This would be our price target, 166.2. 166.2. We have that aggressive push or reach towards 166.2. We have the retest to fill in some inefficiency at 172. So we can utilize 172 as our stop loss / entry, and then target 166.2 as a PT. So modeling the risk to the downside based upon our higher time frame bias, this is what that will look like. Stop loss over these highs at 163.2. But I like to keep my stop losses tight, so I'm just going to do 172.5, 172.5. Nah, that's way too tight. 172. Let's do 50 cents above this high, so 173, 173.2. Entry, looking for 172 reject for a price target of 162, and then a possible continuation through this aggressive or higher time frame weekly supply zone. All right, let's go ahead and mark off our hourly supply to find extra confluence within this trade. So I'm looking for dojis again. I see one here. Dojis essentially are plus signs indicating where buyers and sellers are at equilibrium. All right, within this range, I don't see a doji. So this is a scenario where I would go down to the lower time frame, like the 30-minute, and see if there's one on the lower zones. All right, on the 5-minute here, I see that there's a doji here. So I'm going to mark this off as my 1 hour demand. So we have 1 hour supply up top right here, which appears to be giving us that rejection that we were looking for. Strong sellers, price came back to retest structure to target this low to put in another lower low. So stops would be, we said 173.2. Entry looking at that 172 rejection. With a price target of 166.2, which was Friday's low. So today's low. All right, so that is a simplified breakdown on consolidation, retracements, expansions, rejections. To give you guys a quick recap, consolidations are essentially areas where there's indecision, there's liquidity above a cluster of candlesticks indicating indecisive price action. It's sideways, not going up or down. You can utilize a doji on the higher time frame to identify that sideways price action once you zoom into the lower time frame. I like to use them as reference points as it's easier on my eyes and to kind of replicate over time and do the same thing, to have the same systematic processes over a larger amount of trades. We also talked a bit about retracements. Retracements are when price pulls back into those supply and demand, support and resistance zones, or dark pool key areas. The way that you find a retracement is by looking for an expansive move to the upside or downside. So you want to see price break aggressively to the upside, as indicated by the Moribozu candlestick or long green candlesticks, long bearish candlesticks, whatever you want to call them. And you're looking for it to fill in some imbalance before continuing to the downside or the upside. And then we talked a bit about the long as well as short position tools. The way you find these tools is by going to your measurements and predictions sections under your drawings within your trading view. And it just helps you to model your risk and understand where you are within your stop loss, entry, and your exit. All right, so that is all I have for you guys for tonight's session. I'm going to now open it up for Q&A. Haha. Can you explain how you draw the zones again, please? Yes, ma'am, this is recorded. So you trade on a higher time frame. Great question. I don't trade on the higher time frame. I identify higher time frame biases, and then I check my trades on the lower time frame once price comes to my point of interest. Great question, Yana. So I'm waiting for price to come to my point of interest. I never just blindly jump into a trade. I'll literally wait weeks for a trade to come into my key zone for the highest risk to reward for both the upside as well as the downside. Would be great to see it back tested for sure, if you can, please. Yeah, we can back test. You use doji to draw S&D on higher time frames, but how do you draw on lower time frame? I think I missed it. So a great way you can draw S&D on the lower time frame is by looking for a strong impulse move to the upside or downside before a rejection. So what is that? What does that look like? So let's say we go to the 15 minute. Let's just go back in the past. We go to the 15 minute. So the way that we find our demand zone, or the way that I would find my demand zone, is by looking for either a strong gap up to the upside or a strong impulse candle that tells me where there's strong buying interest. So if we look here, we can see that there's two touches of support at the bottom of the zone. Price went up aggressively. So if I were looking for a higher time frame, let's say demand zone, I'd wait for price to come back to this area before the aggressive push to the upside, consolidate a bit, break out, and then retest again before taking it back to the upside. So as we can see here, we have a area of consolidation right at the bottom of this zone before this aggressive impulse move to the upside, I'd look for price to break out of this zone, then come back in to retest before considering buys altogether. Same situation for puts. Price had an aggressive impulse move to the downside here at 143.3. I'm looking for price to consolidate once it returns back to this zone, break to the downside, retest, and then come back lower. As we can see here, price gapped down to the zone and it didn't give us the consolidation. It just fell all the way through, right? So I probably wouldn't have taken this trade until we got this upper wick indicating a retest of the zone, right? I wouldn't have caught this entire move because it just didn't fit my strategy. But if we zoom into, let's say, the 5-minute time frame, we could see that retest happening based off of that logic. Here we go. Price gapped to the downside, gave us the retest, and then I would have looked for puts to the downside. How would you apply this to those who day trade? Like, can we use this method to determine whether to buy calls or puts for the day if we are predicting retracement? I'm not articulating this question properly. I'm sorry. Yes, yes. You can use this for day trading, scalping, and swing trading. You don't necessarily have to look at the higher time frame if you're day trading or scalping. I personally think it just makes more sense because you have a higher time frame bias that gives you a higher probability of being right for the upside or the downside. Like on day trading, of course you could, take a long position into some higher time frame supply zone. But if there's a higher risk to reward for the upside that you could possibly swing, I personally will wait for price to return to my higher time frame supply or demand zone before taking the trade as a scalp or day trade and then letting it run into a potential swing. But people are different. I'm a busy professional. I don't like to look at the charts all day. So I just chart the higher time frames, set my alerts, and allow price to come to me. Will you be live trading every day and do you trade futures? No, Haven, I will not be live trading every day. I'll be live on Tuesdays and Thursdays, and I'll be doing the watch list with Mr. Rico. I solely trade derivatives and long-term equity.